Coming up on this week's episode of Check Your Balances, we welcome Stewart Patton, who is a U.S. tax attorney and expat entrepreneur to the show to talk about living and paying taxes abroad. Stick around, that's coming up next.
Check Your Balances is a show produced and owned by Craftwork Capital. The views expressed by the hosts and their guests are personal opinions and should not be considered personal financial advice or the opinion of Craftwork Capital. All investments have risk and may lose money. Consult with your financial advisor, tax preparer, or attorney prior to implementing anything discussed, and please do not use this show as the sole basis for financial decisions.
Welcome back to another week of Check Your Balances. I am Ross Anderson, joined as always by my friend and co-host Dan Maseka. And this week we've got a special guest with us, joining us from U.S. Tax Services. U.S. tax attorney and expat entrepreneur Stewart Patton is joining us on this week's show. Stewart, thank you so much for making time for us today.
Yeah, well, thanks for having me on. I appreciate it.
So we've got a lot to talk about here. One of our prior guests on our show literally told us don't even wade into expat issues because they're so complicated and that we're going to get blown up in our email. We're willing to take that risk with you today because we think that we've found the right guy to talk about this with. But can we just start with kind of your background, either academically or where you grew up, and just give us a little bit of color on your path?
Yeah. Well, so I grew up in Oklahoma, and then I got all the way to Texas for school. And then at some point in my life, I thought maybe there's more to the world than Oklahoma and Texas. And it turns out that in fact there indeed is. And so I went to Chicago, and at this point in my career, I'd been at big law firms my whole life, which, that lifestyle is a bit challenging, especially when you have young kids. You get to see them on some weekends, and so basically got tired of that whole thing and wanted to change, and also just wanted to be around more family raising the kids. And my wife is from Belize, and so we basically kind of swam upstream to spawn, I guess, for her at least. But we'd already spawned, I suppose, just to raise the kids. Or this is maybe not the proper analogy for any fish experts out there. But anyway, so about 10 years ago, came down to Belize and left the whole big law firm thing behind, and now I do my own thing, and I do international tax kind of both ways. Basically, I help Americans who live or invest outside the U.S. also help non-Americans who are doing something related to the U.S. So yeah.
I've always heard that when you're working with people moving out of the country or from abroad to the U.S., that it's so specific as to what country you're dealing with. Is it a challenge kind of making sure you understand what's happening specifically as far as the country laws for each client you're working with?
It can be. So there are definitely some generalities, and there are some groups of countries that are similar, and there are groups of fact patterns that are similar. But yeah, you're totally right. So if an American is going to move to the UK, for example, or Canada, for example, or other countries that have large expat American populations, then I think it's makes a lot of sense for them to contact a firm that does tax return preparation and tax advice on both sides, and they'll have access to that. And there are lots of those firms and those individuals who can help with that. But for other folks, there definitely are some generalities. I mean, my specialty somewhat is in helping Americans who leave the U.S. and then don't pay tax anywhere outside the U.S. A lot of these people are digital nomads. So they're traveling around, and so they don't become tax resident in any other country. And so U.S. tax is the only tax for them. And so those people have had a hard time finding advice too, because it's they're a bit different than other types of Americans. But yeah, you're right. I mean, things can be very specific for people going to a country.
Well, so you answered why Belize for yourself, obviously, with your wife being from there. Not having spoken to you yet, my guess was that there was some tax status, and then the fact that it's English speaking, if I'm not mistaken, in Belize. I hear a lot of people talking about retiring to Colombia. That seems to be a popular destination. Are there a couple hotspot countries that you see Americans really pushing towards? And are there reasons that are drawing them to those specific places as kind of a destination?
Yeah. Well, I see people all over the map, and but yeah, I mean, Belize. We have something called the Qualified Retiree Program, where as long as you're 45 years old and you can show that you're bringing in something like $2,000 a month or something like that, then welcome to Belize, and you get basically permanent residence, and you don't pay tax in Belize. So that's pretty cool. And then there are lots of little pockets in Mexico and Panama, and Colombia, Costa Rica. Lots of popular places in Europe. A lot of people go to Portugal. They have / had. There's some complications going on, but there's a program called the non-habitual resident program that provides some tax benefits in Portugal. So yeah, there are definitely kind of little hotspots everywhere that people go to. And then for like younger folks, generally, and some retirees, Southeast Asia is very popular, like Chiang Mai, Thailand, and lots of places around there. So yeah.
This idea of the digital nomad thing is interesting. I've had a couple clients bring that up with me, but mechanically it sounds pretty hard because you're almost a resident of nowhere if you're actually severing ties with your home in the United States. How do people make that happen? Because I assume you need to file as a resident of a particular state. And if you no longer own property or have a true rental, what do people do?
Yeah. Well, okay. So state tax, it's one of those things where it can be very simple and it can be very complicated, which all depends on which state you're from. But in general, and also like state and local tax is probably the worst class I took in law school. We read cases on the most boring parts of the Constitution, like the substantive due process clause and the commerce clause. Anyway, so this is a horrible area of the law. And then also the other reason that makes it horrible is some states are just nuts, like clinically insane. I think their tax departments, and they don't care what the law says. They want your money, right? And so that's why it's hard to give advice to people sometimes, because it's like I tell people, look, I'm a lawyer. I read the law. I can tell you what the law says, but the California Franchise Tax Board, they don't really seem to care as much about the law as I do. So, but basically, so let's just start with the beginning on state tax. So actually, let me kind of start with the beginning on U.S. tax for an expat, and then that'll kind of lead to the beginning on state tax, right? So, okay, so everyone knows that the U.S. is basically the only country in the world that has citizenship-based taxation, right? So, when the three of us chose to be born as Americans, we were choosing to pay U.S. tax until we're no longer Americans, right? So, and so sometimes people can kind of extend that idea to state tax, but it doesn't work that way for state tax. So state tax, the concept is more like the concept of every other jurisdiction in the world, which is like a tax residence concept. So the word is domiciled. So basically, a human is subject to tax in a state on their worldwide income if they are domiciled in that state. And a human is domiciled in a state basically when they live there and intend to keep living there. So generally, facts here are pretty easy. There are some complicated facts, like if you happen to be a U.S. senator and you go to the Washington D.C. a lot, well, that's complicated. But in general, if someone lives in California from January 1st until June 30th, at which point they get on an airplane and they go to start their new life in Colombia, well, they're no longer a domiciliary of the great state of California. And so in general, they are done with tax in California. And so that they file a part year resident return for the year that they leave. And then that's the end of it. They don't have to pay tax in California anymore. And so it is perfectly possible and fine. And there's nothing weird about being a U.S. citizen and then not being a resident of any state for tax purposes in that state. And then, you can lay on other things. So there are any number of other legal and other concepts related to residence. And so things can be different there, right? So health insurance, for example, like sometimes people use the marketplace or in a particular state to buy health insurance. So they want to be considered a resident of that state for that purpose. And maybe that works. So maybe there is a way to be considered a resident of a state for some purposes, even though a person is not domiciled in that state for that state's tax purposes, So basically it's perfectly fine to not pay tax in any state, And that same sort of idea kind of carries over to non-U.S. jurisdictions for digital nomads. So every country, is going to have their rules about who is a tax resident of that country. And the rule of thumb here, whenever you're talking about 200 countries at one time, the rule of thumb is generally that if you don't spend more than 6 months in any year, or maybe in any 365-day period in a country, then you don't really need to worry about becoming a tax resident of that country. That's sort of the general rule. But obviously, countries can have more particular rules where they might look at like the locus of your economic activities and things like that to treat someone as a tax resident, even if they don't spend that much, if they don't go over 6 months. And then the other thing about the digital nomad lifestyle that's a bit of a gray area, and it's just something that a person has to swallow if they want to get into it, is that, when an American lands in Paris, their passport is stamped with a visa that allows them to spend like 90 days or 180 days or whatever in France. And what that is a tourist visa. So that American is supposed to be looking at the Mona Lisa and like, going up the Eiffel Tower and eating, snails and baguettes and stuff. They're not supposed
what
to be
a promo for France, by the way.
Yeah, exactly.
They're loving us right now.
Yeah. So that American is not allowed to, their visa status in France does not give them the right to work while they're in France. And working includes opening up a laptop, on the kitchen table of an Airbnb and being an employee or an independent contractor working for a U.S. company or running your own business online or whatever. So that's the little, to kind of square the circle, Dan, of what you were getting at, isn't this sort of weird? Yeah, it is sort of weird. Because Americans who are digital nomads are technically in violation of their visa status in each country they go to. But the jails of France and Spain and Portugal are not full of Americans who did that. Instead, the beaches and the museums of those countries are full of those Americans, So it's one of those things where, and also, France probably doesn't really care because the American is there buying stuff, and they're paying VAT on everything they buy. And so they're paying some sort of tax and they're stimulating the economy. And so it's sort of a benign, breach of the rules, I guess.
Yeah, that was actually what I was going to ask is, how specific is it to whether or not those countries have a hefty income tax, or if they're just building it in to a VAT or some sort of a sales tax system where, if your tax base is basically creating all the revenue they were going to get anyway, I can't imagine they care. But if it's an income tax based system, or predominantly an income tax based system, I would suspect that they're a little bit more intense on figuring out who you are and what you're doing there.
Yeah, so that's why you don't want to draw attention to yourself, right? So whenever you land at the airport, if you have a laptop in your backpack, well, that's because you don't like doing email on your phone. And so you need to keep in touch with mom. And so you've got to type on a laptop to do that. Or that's so you can Photoshop the pictures of the Eiffel Tower that you take or something like that. Don't tell them about, and sometimes people go through great links, like they'll have like different, like where if you turn the laptop on, like the home screen just doesn't have anything on there. Like, you don't want it to say, you don't want to have like work folder. Like this is a folder where I keep all my work stuff, don't do that, So yeah, some, and there are stories, but generally, the worst that happens is someone gets turned away and they say, no, we're not going to allow you to enter our country knowing that you're going to be in violation of your immigration status. So, it's, I don't think I've ever heard a story of like anyone actually literally getting arrested or anything like that. There'd have to be other, facts that where someone raised the ire of a country for something like that to happen.
So we've talked a lot about Americans heading overseas, whether that be to be a like permanent tourist in multiple countries or to live somewhere else. But I also hear frequently of Americans looking to invest overseas, most notably people looking to buy properties close by in a place like Mexico, where it might be easier to access real estate at more attractive price points. How does that impact someone's tax situation if they want to say open a Airbnb in Mexico or a resort in Mexico, but stay in the United States?
Yeah. So let's talk about how that works. So kind of a way to kind of split the world here is into numbers and then words. Okay. So, and I'll explain what I mean there. So, normally whenever you talk about tax, you think of numbers. You got income, you got deductions, you got taxable income, you got the tax you owe, you got tax credits, right? So when it comes to just the nuts and bolts numbers of paying tax, in general, the way to think about investing outside the U.S. is that it's going to work out the same as investing in the U.S. Okay. So, there's this big misconception out there that's created by the media whenever they report on Apple and Microsoft keeping billions of dollars outside the U.S. so they don't have to pay tax and things like that, which was never true, but now is definitely not true after the Tax Cuts and Jobs Act of 2017. So let's do like you said, real estate in Mexico, right? So like an American just buys real estate in Mexico. In general, they should expect the tax consequences to be basically the same as investing in real estate down the street from them in the U.S. Okay, but there are going to be some differences. So first thing is, well, if you make money on the soil of Mexico, you should expect to pay tax in Mexico on that, right? And so at first, this sounds terrible. Wait, I got to pay tax in Mexico and the United States, so that's not good. Well, so that's why there's something called the foreign tax credit. And the foreign tax credit, pretty simple thing. What it is a reduction in your U.S. tax bill by the amount of non-U.S. income tax that you pay on that income. So this is not a deduction. A deduction reduces income. This is a tax credit, and so it directly reduces the actual tax, right? So you make $100 of rental income in Mexico. Let's say the Mexican tax rate on that is 20%. You pay $20 of tax to Mexico. Let's say the U.S. tax rate, the effective U.S. tax rate works out to be 15%. Well, on your U.S. tax return, it's going to say $100 of income, $15 of tax. But then you say, I can claim the foreign tax credit. You attach IRS Form 1116 to your tax return, and that gives you $20 of foreign tax credit. And now your U.S. tax bill is $0. Okay. So a couple of particular special rules on real estate are that, there's a transaction called a Section 1031 like-kind exchange where you can trade one piece of real estate for another piece of real estate and not pay tax in the middle. When you're talking about non-U.S. real estate, you can only trade non-U.S. real estate for non-U.S. real estate in a 1031 exchange. So you can't cross the border, basically. And then another rule is that depreciation gets stretched out. So you can only depreciate it over 40 years using a straight line method. So you kind of get worse treatment on depreciation. So, but otherwise, all the other general rules would apply there. Okay, so that's kind of the numbers aspect. The other thing, like I mentioned, is the words aspect. And so this is probably a bigger deal than the numbers aspect for most Americans who are investing outside the U.S. or living outside the U.S. Basically, how it works is that the IRS is a little bit nosy when it comes to Americans with assets outside the United States. So there's just this entire panoply of disclosure rules related to non-U.S. stuff. Okay. The easiest one, the one that kind of everybody's heard about, is called the Foreign Bank Account Report, or the FBAR. So technically, this is not part of a tax return. Technically, it's a separate form, and it's kind of scary because it's called FinCEN Form 114, and FinCEN is the Financial Crimes Enforcement Network. Dun dun dun. It sounds like a part of the U.S. government you don't ever want to be dealing with. But
pretty intimidating.
Yeah. But functionally, the FBAR is done as part of your tax return. It's administered by the IRS, even though it's originally done by FinCEN. And so tax return preparers do the FBAR as part of their software. But basically, the Foreign Bank Account Report is where if an American has more than $10,000 across all of their non-U.S. bank or brokerage accounts or other financial accounts that are like those things, then you just have to do the FBAR. And so then also, if a non-U.S. If an American owns a non-U.S. legal entity, then they'll have to include a special form in their U.S. tax return, depending on the U.S. tax classification of that legal entity. So for example, if an American owns a Mexican company that owns Mexican real estate, then they'll have to include a form in their tax return for that Mexican company. And this is an often overlooked thing. If you're a real estate investor and you've got the best CPA in your local jurisdiction who knows all the rules and is able to, wheel and deal and do cool stuff with real estate, and then you tell them, oh yeah, I just bought a condo in Puerto Vallarta. Well, he's just going to add it to your Schedule E and off you go. But if you own that condo through like a Mexican company, well, you actually need to first think about how to classify that Mexican company for U.S. tax purposes. Generally, you want to elect for it to be a disregarded entity. And then if that's what you do, you need to include IRS Form 8858 in your tax return. And if you don't, then the IRS could impose a penalty of $10,000 per year just for not including that stupid form, even when you report all the income you're supposed to report.
That seems like a fairly heavy stick to carry around. That I would at least file the paperwork to avoid a $10,000 penalty.
Yeah, exactly. Yeah, and it's funny. I mean, $10,000 is like the IRS's favorite number when it comes to these penalties. I guess they figure once you get to 5 figures, it looks like a big number. And then there are various amnesty programs that people can use to catch up on these filings if they haven't done it yet. And that's a lot of what I do is consultations with people on which amnesty program to use and how to navigate that whole thing.
So people that have basically been doing it wrong, either just because they simply didn't know or whatever has led to that, and then they're trying to get right with the IRS on whatever their situation is.
Yep. Yeah, exactly. Yeah, because the penalties are phrased in a way where the penalty is due if the proper form is not included in a timely filed return. So once you figure out that, once you first learn about these forms, there is no way to catch up, unless you have a time machine handy. And so that's why the IRS created these amnesty programs to allow people to get back, get a shiny gold star, back next to their name in the IRS supercomputer.
So when you were talking about the kind of giving up state residency, the thing that came to mind for me was something that we've run into several times in our practice, which is people that don't have a U.S. address that we can put on a brokerage account. And we work with our primary custodian is Charles Schwab, and Charles Schwab is a massive international company. But for us as a U.S.-based RIA, if somebody is not in the U.S. currently, it turns up all sorts of red flags if it is not a physical home address. So
yeah.
How are people dealing with that? Where do you even register your assets if you're not currently living in the U.S.? Because my experience is that a P.O. box, they basically kick that back and say, I don't care what this is. Where are these people?
Yeah, exactly. Yeah, so the whole address thing is kind of usually the first existential crisis of the new expat or digital nomad. Like, where am I? Who am I? What, and so what I tell people is, okay, in general, whenever someone says, what is your address? In general, what they're saying to you is, one day I may have a piece of paper in my hands, tell me the magic words to write on an envelope to cause that piece of paper to go to your hands. So in general, without any other considerations, like you mentioned, we're just talking about a mailing address. And so there's a ton of ways to get a mailing address. You can use Earth Class Mail, or there are lots of different services that you can use. Okay, like you just mentioned, banks, brokerages, things like that. If you give them an Earth Class Mail address, they have some kind of system that sniffs those out, and their system is good because some of those services, like it doesn't say Bob Smith, care of Earth Class Mails, number. It looks like a street address, but they know it's not. They know it's Earth Class Mail or whoever, right? So in those situations, I mean, I think what a lot of people do is use a relative's address or a friend's address in the U.S. I have not seen brokerages ask for a utility bill or something that ties that person to that address. So as long as you're okay with mom, getting your mail related to your brokerage stuff, then that seems to work perfectly fine.
Interesting. Yeah, I've seen both. I've seen people be able to do that, and I've also seen them ask for some secondary authentication, like a utility bill or something else with their name on it, credit card statement, something like that. So, that seems tricky. And I think growing up, I had this sense that the tax code was a very simple thing where you just fill out the form right? Whatever there is, there's a right answer. As I've grown with my understanding being in financial services, it's really a place where you're going to choose how aggressive or conservative to be in many areas. And there are certainly things where there's a hard line and it's yeah, that's illegal, that's fraud. But outside of that, this seems like an area where there's a lot of, I mean, even the visa example, right? I mean, you've got to be comfortable that there's not necessarily a passport stamp that says, yeah, you're allowed to be here and work here. You're going to kind of operate a little bit in the gray area is kind of what I'm hearing you say on all of this stuff.
Yeah, absolutely. I mean, that's, it's kind of weird because we're developing AI that's starting to work pretty well. We got robots fulfilling orders in Amazon centers. I mean, we're almost like Jetsons level, right? But the world is still created around well, you're supposed to just, if you're an American, well, you're supposed to just live in America, and if if you do some crazy thing like 3 months in Chiang Mai and 3 months in Phnom Penh and then another 3 months in wherever else, then there aren't ways to classify you. So that's just one thing that Americans who do the digital nomad thing are just going to have to realize that you're doing a weird thing and weird things are going to happen and just kind of be okay with that and just roll with the punches a bit but I haven't ever seen any just huge monumental things crashing down on people's heads because of this. It's always just like little things like, okay, you got to be okay with, mom might accidentally open your brokerage statement and see how much money you're making or whatever. But yeah, I mean, I haven't, it seems like this is one of those things where there's always a workaround and it's not impossible. It's just, it might be a little bit complicated.
I mean, honestly, at the end of this conversation, I'm feeling like the scariness of moving abroad or investing abroad has largely been wiped away from the individual standpoint. And it's all about finding the person who knows the right boxes to check and the right reporting mechanisms. I mean, for me, who has always had dreams of doing both of those things at some point, it's kind of encouraging. It's like, this isn't a deal breaker. It's not going to come crashing every hope and dream you've ever built up in the US. It's just a matter of working with the right experts to report it properly and make sure no one hunts you down later on for evading some sort of tax you had to pay.
Yeah, absolutely. And, different fact patterns are different. There are some people who basically not much changes in their tax life when they move outside the U.S. And then other people, everything changes, right? So for example, like you're mentioning retirees, that was kind of one of the examples earlier. So let's say a 65-year-old American moves to Boquete, Panama, and buys a house, and they're chilling in Panama because they're tired of winters and in Chicago or wherever else they were.
I'm sure that's never happened. Nobody's tired of Chicago winters.
Yeah. And so, but let's say their income sources are like IRA distributions. They sell a few stocks every once in a while. They have a few dividends and interest every, here and there. Well, if you look at their U.S. tax return, you may not even know they live in Panama. They may not even open a Panamanian bank account, because maybe they don't really need to. Like, they might just pay for everything with a credit card, And so, maybe on their U.S. tax return they use their Panamanian address on their 1040. Maybe they don't. Maybe they, for on the 1040 you can use an Earth Class Mail address, or you can use, your kid's house in the U.S. Wherever you can get mail works, and so. So their whole tax situation just may have nothing international going on. And so, if they book a consultation with me, it's going to be a pretty short consultation. And I'm saying, well, okay, now someone else, let's take a 25-year-old who is about to start an e-commerce business. Well, if you're in the U.S., you have like an S corporation or something generally, right? If you leave the U.S. though, you have the opportunity to own your business through a non-U.S. corporation, and so that's where it's like basically a new legal structure. Your tax return is going to have crazy forms in there, like IRS Form 5471. Which is like the worst tax form. It's got all kinds of jargon. It's got, cites to Treasury regulations all over the tax form. And so it says like, yes or no, have you done a transaction described in Treasury regulation, blah, blah, blah.
Oh, goodness.
Like, you can't fill the form out unless you've, been to law school or are a CPA who does it, So basically their whole thing is international. Like, they got all kinds of, they need a new tax return preparer who knows this stuff. They need to figure out whether, and this is where I help, is helping people figure out whether it's a good idea to to use a non-U.S. corporation in the first place in their particular circumstances, and then they need to set it all up and everything, and so yeah, it's just different situations are different, and so some people it's very simple, and other people they have international stuff all over their return, and their situation entirely changes.
I made the mistake of pulling up IRS form 5471, and I now have a headache. I'm going to go take an Advil after this.
Yeah, and after the 2017 Act, they added all these new schedules, and I mean it is nuts. I mean it is really the worst tax form I've seen. Yeah.
So one of the things just on your couple that moves from Chicago to Panama that you didn't mention, I just want to clarify it because I think it would be a question for a lot of people listening to this thinking about retirement. Is there any situation moving outside of the U.S. to another country to retire where you don't get your Social Security?
Yes, I believe if you move to like Iran or North Korea, I think like places like that, I think you don't get Social Security. Other than that, no. Other than that, I mean,
that was a nice teaser answer, by the way. Yeah, the answer is yes. There's places where you don't get it, but you're probably not going.
Yeah. I mean, to further illustrate, I mean, if let's say an American moves outside the U.S. and renounces their U.S. citizenship, like they go to a U.S. embassy, they raise their right hand and they say the oath of renunciation, and then they get what's called a certificate of loss of nationality. So they are no longer a U.S. citizen. Well, that person still gets Social Security.
Wow.
So yeah, it's a pretty surprising result because Social Security is a different deal, than tax. Even though we always think of them as related, especially those of us who get to pay the full self-employment tax, which I still pay. And
we're out here loving it.
Yeah. But yeah, it's sort of it is a different deal between an American and the U.S. federal government, and so yeah, you're still getting that, and yep.
So I know we're running a little bit long. We want to make sure we're respectful of your time. We're going to link your website so that if people are looking for you and would like to reach out to you personally, certainly to the show notes. Is there another resource or some sort of association of international tax professionals that you would recommend if somebody's kind of going through this and saying, who do I even talk to? Where do I start? Is there a group of providers that have kind of banded together and said, this is our specialty? Because we're not familiar with it if there is.
Yeah, I don't think so. Like, there's definitely no group like that I'm a member of or affiliate. Maybe they just didn't call me to invite me or whatever. I don't know. But yeah, no. So on my website, I've got a bunch of articles, like 40 or so articles that have some initial learning on this stuff. I've also got some online courses as well. And the IRS put out publication 54, which talks about this stuff, and so that's a good place to start as well. But yeah, so like the retiree scenario is something where it's pretty easy. There aren't much benefits, but like the scenario that I get more excited about is like with young people. So like something we haven't, I just want to mention this since we hadn't talked about it yet. So there's something called the foreign earned income exclusion, which, it's basically a deduction. If you're a tax professional, you know that an exclusion and a deduction are a slightly different thing. But if you're a normal person, you know that it's a down arrow in your income, so it knocks out income. And so what it is it's $120,000 for 2023, and the number goes up by inflation, so it'll be a little bit more each year. But basically, if you leave the U.S. and then spend less than 35 days in the U.S. in each calendar year, then you'll qualify for the foreign earned income exclusion. So your first $120,000 of income that you make from working is free of U.S. federal income tax. So for retirees, it doesn't do them any good because it only works for income from working. But for like the 21-year-old software developer who like wants to travel the world, do the digital nomad thing, okay, the U.S. tax on $120,000 is like $25,000, something like that. And $25,000 goes a really long way in Southeast Asia or in South America. So basically, the U.S. federal government will finance your gallivanting around the world, and so it's a pretty cool it's a pretty cool thing.
That's massive. I mean, that's just huge to know that you can earn up to that level. And it's not like you're not getting crushed. Is it a cliff after that, or does it just go back to the regular tax code?
Yeah, so it goes back to the regular rate, and how the math works behind the scenes is that you save the U.S. federal income tax on the first $120,000 that you make, no matter how many dollars you make. So let's say the tax on the first 120, just based on the brackets, let's say it's $25,000. Well, if you make 130,000, you're saving 25,000. If you make $1 billion, you're saving 25,000 as well, right? And so right at that, the 120,000th and first dollar, you're paying tax on that if you're single at 24%.
Got it. Okay. Yeah, I think Dan's coming away from this encouraged. We deal with state regulators for our securities licenses, and that is such a pain. And I won't push you into that because I know that's not your wheelhouse here, but it feels like the world is moving faster than regulation is. And so a business like ours that can basically serve a national audience because we can do it virtually, we're stuck registering with each individual state, and every state wants to change some silly thing in our contracts. And I won't call anybody specifically out, but it's just incredibly challenging. And it feels like you're in a similar world where the law has not quite caught up with how people are actually living. But we're very appreciative that there's people like you trying to help people figure that out.
Yeah, awesome. Well, thanks for having me on, and getting a chance to get this. Now, it sounds like we're kind of winding up. Before we go, there's one weighty issue I wanted to.
We're fine on time.
Okay.
We were trying to make sure we got you out of here without holding you too long. So if there's something we should get into, we're here for it.
Well, I just wanted to weigh in on this issue that you guys have discussed on your podcast before. So when I make a peanut butter and jelly sandwich, I use one knife, and I don't understand. I consider myself a pretty tolerant person of other people's beliefs and practices, but these multi-knife people, I don't know what in the world.
They're the worst.
Yeah, I don't know what in the world they're doing.
I'm here. That's all right. If that's the worst thing I do, I can live with it.
I knew we picked Stewart for a reason. He's good people.
That's hilarious. I make like one peanut butter and jelly a year, so it's not like a common thing for me. So I love just being the antagonist in this fight. I'm willing to take on everybody that my way is better, even if it's less efficient. That's awesome. Well, we appreciate that you tuned in and checked out some of our show. We will, again, link your stuff. But Stewart Patton, we appreciate you, bud. And thanks for coming on the show.
Thanks for having me. I appreciate it.
For the rest of you out there, if you've got questions for us, checkyourbalances@outlook.com is the email address for us. We're going to have a December mailbag coming up shortly for you. Appreciate you tuning in, and we will catch you next week.